Hello everyone, hi, welcome to the channel of Wall Street Mojo. Watch the video till the end, and also if you are new to this channel, then you can subscribe us by clicking the bell icon. Friends, today we're going to learn a topic that's called audited financial statement. Now, every listed companies, they need to get its accounts audited by auditor. So an auditor is basically a certified public accountant if it is in case of US, or a CP of Australia if it is the case of the Australian government, and if it is India, then it's a chartered accountant. So they need to get their accounts audited. Now, what is the purpose behind auditing any accounting statement? Okay, let's not get into that first. We'll understand what exactly is there in front of us first. As you can see, there is an audit report over here, or opinion on the financial statements and internal control over financial reporting. And it's written, let's read. We have audited the CFS, including the related notes and the FS of Colgate and its subsidiary as listed in the accompanying index. We also have audited company's internal control over the financial reporting for the following year based on the criteria. So, as you saw that, this is basically the report where the data regarding the opinion of the auditor has been contained over there. So, as per the law, what first of all we need to understand what are the audited financial statement. That's the first thing that we need to understand. Now, as per the law, all the listed companies are required to get the financial statements audited by an authorized, you can say CPA. It can be CPA or a CA or Australian CPA, and so on and so forth. There are different kind of CPAs around the globe. Now, remember one thing that audit plays a very critical role in lending that element of the creditability of the financial information about a company, which would go on a long way in assuring company stakeholders, especially one involved in making the economic decision and you know about the authenticity or otherwise or any financial declaration of the company. Now, you can say that usually an independent financial auditor is hired by a company to carry out its audit of the financial statement, and whose opinion offers a kind of the unbiased and a competitive view of the financial performance of the company. You can say that. So, in the recent time, if you see, the audit of the financial statements have increased in the significance after it was brought to light in several occasions how some of the big industry players have made fraudulent disclosure which has only served to erode the investors confidence. And the one big example I'll give over here is the Lehman Brothers. They not only had the exposure, but they played around cooking the books and probably made a huge mess. So it is also the reason for the introduction of the far more stringent norms widely employed in the financial reporting standards. Now, we need to understand which are the top financial statements to audit. The first financial statement is the income statement. Now, this is the statement of the financial performance of the company over a specific accounting period, and it shows the revenue and expense that have been incurred through the operating or non operating activities, as well as the net profit loss incurred during the period. The next set is the balance sheet. Now, this is basically the statement of the financial position of the company at a specific point of time. And this is done by, detailing the assets and you can say the liabilities, and you can say that it also involves the shareholders' equity to give an idea of what the company owns along with the liability. So the balance sheet is prepared on the basis of the criteria. It's something like this: your assets is always going to be equal to your liabilities plus shareholders' equity. The next sort of financial statement is the cash flow statement. Now, this is the statement of the cash and cash equivalents and released by the company during a specific accounting period. So, these financial statements are are the ones often utilized for the audit purpose. And however, some adjustments might be made to the statement by company after finalization of the audit for better representation of the facts. Now, let's see some of the phases of the auditing financial statement. The first and the foremost phase is the planning, and the risk assessment part. So this is the initial stage, which involves putting together an audit team over here, and laying down the general guidelines for effectively carrying out an audit. The next step is basically to determine any risk, if that follows, that could lead to material errors in the statements. Identifying such risks require a thorough knowledge on the part of the auditor in respect of the industry and the business environment in which the company operates. The second thing is the internal control testing. Internal control testing. So this stage involves a critical analysis of the internal control adopted by the company and their level of efficacy, you know, uh, in eliminating all the possibility of the material misstatements in the financial statement. So this internal controls could include, automated systems, you can say processes by the employed by the company to ensure higher operational efficiency, safeguarding of the assets, and making sure that all the transactions are accurately reported. The third step which goes in here is the substantive procedures, or you can say that substantive testing. Now, at this stage, the auditor looks at this kind of evidences and cross verification of the facts and figures reported in the statements, which might include something like this, like, you can go for physical inspection of assets if required. Then you'll be given with the cross checking of records, figures in the statements against actual documents and records within the company. And then there is a third party or the external confirmation of the financial transactions and the details are reported by the company. So this often includes an independent confirmation from the of such statement from the, like, third party, like banks. You have your daters, or it also goes with your suppliers, that is your creditors or the trade receivables, which are engaged in the business with. Now there are couple of issuance of audit report which have been done. There are three type of audit reports or the opinion that have been given on the basically in the audit report. The first one is the report on the audited financial statement. Then they have the management's responsibility for the audited financial statement, and the third one is this is the second one. Third one was the auditor's responsibility related to the same. They also provide, if any, that's called the basis of the for if any for the qualified opinion, if that has been given by the auditor. And a qualified opinion if is given only when they feel that they don't have, or the company has violated some terms, or they are not in agreement with. Unqualified opinion is basically when there is no such thing they have found which is derogatory in nature or anything that is violating the accounting policies. So one is called the qualified, another one is called unqualified, and there is adverse when this kind of opinion is expressed by the auditor if they think that there are material misstatements in the financial data presented, and this would require a company to reissue the audited financial statement for the bank audit. And the last one is the disclaimer of audit. And if an auditor thinks that the data represented is insufficient to form any kind of an opinion, then they have been forced to issue a disclaimer of opinion. So that's it for this particular topic. If you have learned and enjoyed watching this video, please like and comment on this video and subscribe to our channel for the latest updates. Thank you, everyone. Cheers.